Today we're talking about the S&P's 3-week losing streak. It was the third one of the year so far. Last time we saw 4 down weeks in a row was December 2022. Now, a quick look at the last 3 years, so there's no real surprises from this perspective, right? In 2022, we had 6 losing streaks of at least 3, the longest being 7 here in the springtime. In 2021, there were 0 3-week declines. Again, no surprises there as well. So what does that tell us? That tells us that 2023 is not 2021 or 22. However, the S&P has had periods in which it resembled both years over the last 9 months. And with rates and the dollar deciding to go straight up over the last few weeks, we know that has felt a lot more like 2022 lately. So let's look at a few stats around 3-week losing streaks. Now, according to marketcharts.com, this is started 2013, so just about 10 years. The S&P had 21 non-overlapping 3-week streaks before this one. Over the next 20 days, over the next month, it was up 81% of the time with an average move of 1.8%. That's pretty substantial, pretty lopsided to the upside. But here's the crazy part. The win rate jumps to 100% if we just remove the 2022 reactions. All of them were lower over the next 4 weeks, again, not including non-overlapping instances. So the point is, we can't simply ignore 2022, of course, because the basic reason is the same factors then now are hurting the market again now, namely higher rates and a rising dollar. So let's look at this a little bit more closely to a period when rates were actually rising, and of course, that is 1970s. So from January 70 through December 79, as rates were rising, the S&P logged 29 3-week streaks on the downside. 4 weeks later, it was up just 41% of the time with an average move of just 0.5%. Now, again, we know that majority of the time, if you go back in history, you go out a month, the vast majority of the time, the S&P is higher. So this is the big difference being lower most of the time after the 3-week losing streaks, right? It's a lot different. So, 4 weeks from now, October will be nearly done. We'll be in the thick of earnings season. And while the worst will be behind us from a seasonality standpoint, a lot will, of course, can happen in, again, just a month from now, especially from a pattern perspective. And that is, of course, the big concern now. And so last week's decline was pretty substantial, got back down below this 43.30 level. And that triggered this sizable bearish pattern that everyone is staring at. So staying below this breakdown zone, of course, would give us a downside target near 4,050, and that would be about 12% move from the top, right? Pretty substantial. So as is typically the case, big down days usually lead to big up days as well. And we saw that, of course, in 2022. So we can't rule out seeing the first 1% gain of the month happening at any point. So if that occurs, of course, this pattern will be in hold, but we'll need to see some follow through if that actually takes place, of course, right? And so if things do unwind further, then the 4,200 area will be in the crosshairs. And that's important for multiple reasons. Number one, it has round number significance. As we can see here, the 200-day moving average is getting close to that. The 38.2-point retracement level of the entire gain is right there as well. It actually has real spots in the past, right? It was the high from February, it was high again in April as well. And then we don't have it here, but if we extend an uptrend line from the October lows, it goes right at that point as well, right? So that's the important thing. And so this is what we have to look for through, of course, the end of the week and into October when volatility continues to be with us. So if you want to see more content like this, click on some of these videos we have here, and don't forget to subscribe. Talk to you next time.